Hello. We're just letting some people join in now. And we'll start in just about a minute. Alrighty. I think we can get started. Thank you all for joining. I'm Amber Reedy. Today's session is Bitcoin's 4-year cycle, the 2025 reality check. We've got Josh Olszewicz, Stephen McClurg from Canary Capital, and today we have a special guest, James Seifert. So with that, I'm going to turn it over to Josh to kick things off.
Sounds good. Thanks, Amber. And thanks, James, for joining us from Bloomberg Intelligence. James has a specific skill set that involves analyzing crypto. I don't know if he's taken it under his wing at his own volition or or if he was tasked with it, but curious to hear his thoughts as they've evolved over the years at Bloomberg. I know he's talked a lot about just like demand and attitudes internally, externally regarding crypto. If you can share any of that with us today, that'd be great. So today's discussion, we're going to be looking at both what happened in 2025 as well as forward looking into 2026. Stephen has some very specific ideas and impacts of what has happened, and we'll go over that, and as well as looking at into the future here in 2026, what that may mean for this year, and basically how bullish or bearish can we be based on certain assumptions. We're going to run a series of polls here. We'll run them for about a minute. Amber, if you can start the first one. I can't run it on my end. It should be pretty
Sure.
straightforward.
Um,
Should be under more.
yeah, I got it.
Okay. Here we go. So first poll here, no pressure. It's anonymous. Crypto exposure. When do you plan to add crypto exposure in 2026, if at all? Are you already buying? Are you waiting for more of a capitulation? Are you waiting for the summer? Are you waiting for a new all-time high? Which could be not this year. Or are you planning to add, not planning to add at all is the question, right? What's interesting today, when I think about this discussion, is as we let this poll run, we are up, 6%, I think, in the last week on BTC. We've seen gold run, we've seen silver run. We're seeing the Qs pull back a little bit. We're seeing Mag 7 pull back a little bit. So for me, the real question is, can BTC pull away from the pack here? Can it get a little bit of the rotational momentum from things like metals and pick up some of that store of value narrative? I think we're good on the poll running. Amber, if you want to finish it, see what the results are, if I can see in here. Here we go. Okay, so I think everybody can see that, but number one answer is already buying the dip. That was James. Obviously, he was voting for that one. I don't know if he's allowed to even say.
I,
Um,
I am not allowed to say.
okay, fair enough, fair enough. Um, second, second, most responded answer was waiting for the summer bottom, and nobody said they were not planning on adding exposure, which is good. I think a lot of people do the opposite. They are afraid to buy the lows. They're afraid to dollar cost average in a bear market. But that's what you really want to be doing. Not financial advice, but over the long term. So anyway, we'll get to it here. Stephen, do you want to go over your initial thoughts about the 4-year cycle, and if the 4-year cycle still exists? There's endless thoughts about this, so I'll turn it over to you.
Yeah, look, really, Bitcoin price does have a lot to do historically with behavior of miners because they are collecting Bitcoin rewards for processing transactions. Every halving cycle, you will notice that the volatility is lower and lower in the cycle because, well, number one, miners are getting a smaller reward of Bitcoin, which they can then either sell or hold based on a lot of different factors. The main factors that come into play for a miner, miners really come down to three different things that they're looking at. Number one is energy prices. Okay. And we'll come back to energy prices, but energy prices are a big driver. A lot of larger miners, older miners have locked down energy prices for long periods of time under contract. The second is hardware, and the third is software. Software is what the better the software, the more efficient your miners run, and then of course hardware is extremely important. Hardware goes, it's everything from the containers, the cooling systems, the transporters, and then all the way down to the miners themselves. And miners, when I talk about miners, I'm talking about the equipment. Um, Typically have 2 to 3 year lives, and they can stretch it to four. So technology in hardware also has a lot to play here. But going back to why miners still matter, not only are miners processing transactions, earning Bitcoin for rewards, they have to sell that Bitcoin for real dollars or other currencies to pay their bills, to either upgrade their equipment, to create better software, or to pay their energy bills. Um, every halving cycle, that effect is going to be less and less. But it's only by half, right? And that's why if you notice on this history of 4 year cycles chart, you will see that each cycle the volatility is lower and lower. And you might notice some patterns here. For instance, in 2020 was up 300% before being only up 66%. So there's a lot of other factors that play inner cycle. But for the most part, the cycle, I believe, is still intact. And you'll notice, well, 2025, Bitcoin was down that year. Well, for where we were at in the cycle, 2023 was a massive year. And that had to do with a lot of macro factors. 2024 was a great year as well. So on a relative basis, 2025 was actually flat. And given the monster years in the previous 2 years, that's why you're not seeing a positive year for 2025. The other thing is energy. So um, AI data centers actually sucked up a lot of the energy and caused energy prices to go up. So some of the small and medium-sized miners had to start selling their Bitcoin faster. And some of the large Bitcoin miners, which are publicly traded, also became DATs, buying up Bitcoin onto their balance sheet using the same strategies that MicroStrategy uses. So their Bitcoin also had a big effect on the market. So the two things that really caused 2025 to be, I'm going to call it flat, negative six is nothing, is high energy cost, and then the basis trade collapsing in ETFs. And I'd love for James to address that a little bit more. But that was why a lot of hedge fund managers sold their Bitcoin ETFs and bought other things where there's a better basis trade. And by the way, when altcoin ETFs were launched this year, a lot of those had better basis to trade on, which is why we saw rotation out of Bitcoin and Ethereum and into things like XRP and Solana and HBAR. So I'm in the camp that the 4 year cycle is still intact. Negative six, and when it's usually positive is really nothing. You've got to look at the 3 years collectively as a whole, as what's the return for that 3 year period. It peaked in October. The last cycle peaked in November. The cycle before that, December. I think you get it. It's all October, November, December of the third year when you get the peak. And then even though we're up so far in 2026, I still don't see a catalyst that's going to drive Bitcoin much higher. Now, again, we're also long Bitcoin right now because we are seeing a short-term run in Bitcoin, but I do expect to see a trough in the summer before the next cycle begins.
Before I get to James on the basis trade and the 4 year cycle thoughts for Stephen, it's all about strong opinions held loosely. So where would you want BTC to be to say, okay, maybe we have an extension of something here, whether it's a cycle or a year or a quarter, right? What level would you say, like, okay, putting you on the spot, what level would you say, all right, this is different this time?
Well, the only thing that makes it a whole lot different this time is macro. So from a macroeconomic perspective, I mean, a lot of countries are in recession. The US isn't in a recession per se. I would say 80% of the US population feels like they are in a recession after 5 years of high inflation. Food prices aren't coming down. House prices aren't coming down. Auto defaults are high. Credit card defaults are high. Student loan defaults are high. And we're talking financial crisis level. So a lot of the country is experiencing, what feels like a recession, even though GDP is positive. So it's almost like a K-shaped economy here. And the other side of the K-shaped economy are people that have assets who benefits from inflation, benefits from higher prices. And their assets have gone up in value and they've got money to spend and they're continuing to make money while the rest of the country, or most of the country, is struggling to pay mortgages, credit cards, and even buying food. So that is what makes this cycle different than what we've seen since 2011.
Gotcha. And now for James, any thoughts on the 4 year cycle? Is it absurd? What is the BI view? What is your view on any of
So,
that?
so I'll give you my view.
Okay.
So I mean, I actually like my view going into like even the last 2 years was that I thought that the 4 year cycle was going to be muted. I just feel like the tails, the massive blow off tops and complete implosions are going to be more limited than we had seen in the past for a multitude of reasons. One, like I'm not the first person to say this, but the ETF stuff over the last 2 years kind of feels like an IPO moment. I'm not the one to coin that term, but it seems like a lot of people are, Bitcoin went over 100K. A lot of whales. You can look at the whales data. They were just dumping huge, not huge portions, but like it's a lot of money for a normal person to see how much money is being. So they're just taking some chips off the table. They probably largely believe in the 4 year cycle. I just think the 4 year cycle, the internal mechanics that Steve was talking about, is becoming um, less of an impact on the price compared to the external impacts of things like ETF buying and DATs and just the macroeconomic environment that Steve was mentioning. So you get to a point, when we went from like 2016 to 2017, 2020, you went from like the inflation rate on an annual basis of Bitcoin being near over 9% to being like 4-ish%, then under 2, and now we're under 1. So I just think like going from 10 to 4 and then for all the way down to where we're under 1. I just think that that whole internal mechanics of the inflation side of this and how its impact on miners is just going to have a less of an impact on the outstanding balance of what Bitcoin is doing. And a lot of the, selling, if you will, and buying is just happening, secondhand on exchanges. And I fully agree with what Steve said about the basis trade. You can look at this at the holding gain ETFs for the first year, or at least the first 9+ months. The largest holder of these spot Bitcoin ETFs were hedge funds, and they were not holding it because they were really long Bitcoin and they wanted long beta exposure. They were in a basis trade, and it was yielding really strongly. When Trump got elected, things went up over 20% on an annualized basis on a theoretically risk-free trade, right? So that collapsed completely in Q1 of this year. And we saw tons of money come out. And when I say tons, it really wasn't that big in a grand scheme of things, considered the price collapse. But we also saw the advisors took the lead by far in the largest holders of these things. Same thing happened with the Ethereum ETF. So just the basis, that inefficient market where you can earn 10+% on an annualized basis in the basis trade, selling the futures forward and buying the ETFs in spot, it's not as, you know, appetizing as it once was. And then yields across all of the assets, whether the main four I look at right now are obviously Bitcoin, Ethereum, and I also look at Solana and XRP. And they are back into double digits right now, briefly, for Solana and XRP, and everything's kind of ticking up. Obviously, with the price, it's correlated to price. But when you see tons of money coming in and you see the basis trade in double digits, we can't know for certain, but it's probably basis trade related. And for the most part, I'm not seeing any indication that the flows in the ETH ETFs or the Bitcoin ETFs at this point are related to the basis trade.
Yeah, I'll come back to the flows piece in a second. A question for you on the basis trade. Shouldn't the basis trade theoretically be neutral, as in not have an impact, theoretically?
Uh yes, you can make the argument that due to the way that futures are inherently levered and the way that people are getting exposure on a notional basis, that there could be some level of impact, whether on the price, but there's like a lot of correlation and causation probably happening there.
Sure.
Because people like to look at the flows of these ETFs and like they're the be all end all. And as anyone can tell you, like they're just a piece of the pie. And honestly, for the most part, they're kind of more reflective of what underlying people are thinking than in the broader market than anything. But in this space, it's interesting because people like to, point the finger at these things for having outflows. And it's like, yeah, these things have seen like 5% of their assets leave while this asset has crumbled 30%
Right.
from the peak. And it's like, guys, the call is coming from inside the house, and you can see it in the on-chain data. It's the whale wallets that are selling these things.
Absolutely. Let's move on to the catalysts individually. Uh, Before Stephen takes over here on the energy side, I think one thing maybe we all have noticed is rising energy prices. And on the Bitcoin miner side specifically, there have been several miners who have just pivoted out of Bitcoin mining entirely. So to me, it's kind of interesting that hash rate hasn't fallen even further lower. Hash rate has come down quite a bit since October, and I just checked it today. It's still basically on the lows uh, of the retrenchment. But seeing all these major miners pivot completely out of mining and into AI data centers, for example, it's surprising to me that hash rate's not lower. So, Stephen, do you have any additional thoughts or insights here on what maybe will happen with energy costs and miners? And I know President Trump talking about some sort of maybe executive order about AI stuff. I don't know. Any thoughts there?
Well, one of the reasons why hash rate is so high is because, over the last 4 years, there's been a big move for more miners to come online in the US. Texas was really promoting it. The new Trump administration was promoting it. So, even late stage, which is pretty unusual. So, despite some of the older miners diversifying into the AI data trade, there are a lot of miners out there producing. And by the way, a lot of them aren't making a whole lot of money. The good miners are producing Bitcoin at about, 30 to $40,000 a Bitcoin on average. A lot of them are 60 to 70,000, and then a lot of them are producing Bitcoin between 80 and 100,000, which isn't great. But it's a sunk cost issue, right? So they've spent all the money building out. Sometimes, in a lot of cases, it's stranded energy, and they're building out around stranded energy, and they've got to make it work. So they're continuing to produce.
Gotcha. And James, do you have any thoughts on the AI pivot away from miners? Is it simply just a better business for these miners?
I think there's a lot of benefits to like having them co-located personally, but I'm not an expert on this. The other thing I would say is like what Steve was kind of hinting at. I think a lot of this growth has to do with like lagged responses. Like when you're planning to build out these things, tons of megawatts. Like it's not like you can just do this and plan to build it and it's there in a month. Like it takes months,
Right.
if not years, to get some of these things up and running. And it's like just because the hash rate's high and prices and where we want it, we're not going to turn it on. So I think that's more what it is. So we might see a lagged effect where like we don't see growth the way that we have seen growth over the last couple of years. But I won't pretend to be an expert on miners or energy costs or anything along those lines. I know to
You
stay in my lane. I do have my thoughts, but I know when to admit when I'm not an expert.
Well, one of the things that I also want to point out here, and this is what it's related to, and a lot of people might understand this, it may come from the energy side, is we spend a lot of time, in on energy, as far as like an analyst and a bond trader for energy companies. But if you think about like fracking, for instance, oil's at over $100 a barrel, and you're going to go out and get oil however you can. So at $100 a barrel, you're buying all this equipment, which, the fracking cycle takes about 2 years to get set up. So once you buy all the equipment, get everything set up, everything's running, oil drops to $50 a barrel. Well, you've got all the sunk costs, you've got bills to pay, and you've got debt that you've got to pay off. You better produce, even though you're losing money, just to cover your debt service. Data centers aren't that much different. There are people that take out loans that a lot of the equipment, a lot of people don't understand this, but the manufacturers of miners often lend the mining machines out to people, and then they've got to pay them back, right? So you're not just buying them, you're not buying them cash. It's a loan, and they've got to produce, even though they're losing money, just to pay that debt service. And those miners only last 3 years.
Right. Definitely adds up. over time on a non-uptrending market. And then on the collapse of the basis trade, this maybe isn't the best representation. This is just Deribit, which is a popular crypto-specific um, derivatives exchange with options. But again, if Stephen or James want to take over here, just to any comments on the correlation, I guess, because I guess the other question is, will the basis expand again, right? Like, what's it going to take for the basis to expand, or are we just done seeing expansion of basis on BTC versus alts?
I guess I
I'll
can
let
go
James take
first.
this one because you follow it so closely.
Well, because when I started covering it, it was like actually driving flows into the ETFs, and people were like, "Oh, look at all the demand for the ETFs," and I kept having to be like, "It's not just that. Like a lot of this has to do with the basis trade." So my view is like, this is still a momentum asset. If this thing starts running, and we start seeing a ton of start seeing price really moving quickly, you see the yield go up. People are willing to, take risks on the futures market and get exposure in that way, and then there's this basis opens up and you get hedge funds and other people willing to step in and try to arbitrage that trade. This is one thing I will give my colleague Mike Malone credit for. He was basically saying this is going to collapse. Like there will be peaks and valleys, but it's not going to be at the level it was once we get the ETFs and different things. And like even before this, like I do it on a monthly, like I do a 30-ish day lag, like looking at the annualized basis.
Mm-hmm.
And some of the numbers like go up to like near 30% on some days. So things can get pretty crazy at different times. But that said, there's this compression happening. It's happening
Definitely.
in vol, it's happening in the basis trade. Things are like kind of getting compressed into that 10 to 5% range. But if we start seeing it running, it will run up again. And like I said, some of these other assets, the more altcoin ETFs, their basis right now, when I last checked, was over 10% this morning. So there are still pockets. It's also the other thing I said already. It's not really impacting flows as much anymore. It was for the Bitcoin ETFs. It's not anymore. It really was for Ethereum ETFs for most of last year, and then that's kind of trickled off as well. So I think it's just over time, people, they arb it out, and it becomes less profitable, and there's less. Once it's in there, it kind of the markets become more efficient. It's a good thing.
Yeah, I mean, look, you want your basis to outperform treasuries, and right now Bitcoin barely does. And if it doesn't, then you will do the same trade on treasuries.
Exactly.
Great. Understood. Amber, let's move to our second poll here. We'll run this for a hot minute.
Sure.
Okay, so what is your biggest concern about crypto in 2026? Further downside, timing of the bottom. Many people think about that. Regulatory uncertainty, macro conditions, Fed policy. Lots of Fed stuff lately. Busy macro news cycle for sure. Lack of retail participation. I think that might be Steven's answer. And asset selection or diversification. There's just more stuff out there and available now, especially when, man, there are a lot of trades that are working right now, and not a lot of them are crypto related, although that's changing slowly this week. So we'll give everybody another 30 seconds here. I don't want to lead the witness, but I feel like the regulatory uncertainty is abated quite a bit with this administration. All right, Amber, let's see what we got here.
All righty.
Basically split all down the middle here. The top answer was macro, which I think is understandable when the Fed is being in the news, let's just say, quite a bit here. Further downside timing, the bottom also up there, but all of these answers appear to be on top of mind for folks. And I think that's also an issue. There's, Stephen already mentioned, not a lot of catalysts on the horizon, and I think a lot of people are thinking about downside more than they are upside, right? So I think that limits inflows a little bit on ETFs specifically, or just allocations in general.
Yeah. I mean, look, I'll tell you what my opinion is. I think lack of retail first and then macro second, but macro's the reason for lack of retail.
We'll throw it back to Stephen here. Again, on the 4-year cycle. And do you have any thoughts on specifically the liquidity piece? Because that was a big one that a lot of people were looking at. And any thoughts on things like ISM or other inputs to the 4-year cycle that we've seen historically move higher with price that haven't yet moved higher? right? People are always hoping and searching for a data point that may still provide some glimmer of hope for the cycle or the year. So is there any of that stuff that you're thinking about for 2026?
Yeah, I mean, and going back to the poll a little bit too, right? It's what I'm really thinking about is retail demand, and that's what I mean, that dried up a year ago. And there's really two reasons. One of them, again, is more macro related, and that's probably the bigger factor. There's not a whole lot of spare income to make investments for people right now when you're struggling to pay. I mean, you could just look at the data and you can see that people are struggling to pay credit cards, autos, student loans, mortgages. People aren't even buying houses right now. And when you don't have money to buy groceries, you're typically not gambling on crypto. And I say gambling tongue in cheek because the people that do have disposable income, and now I'm going to go into more speculation. I don't have the data to support this, but speculation is a lot of retail that does have the ability to that does have some disposable income are gambling on prediction markets. So for the last probably 5 years, I think a lot of retail investors have said, "Hey, I can wager on what the Fed does. I mean, just like everybody else, I'll watch Bloomberg or one of the other channels." And I think I can get enough information where I can make that gamble, and I'm gonna bet on Bitcoin directionally as a prediction market for Fed policy. Well, now you can do it directly via prediction markets and bet on a lot of other things that people care about more. I mean, people care a lot about sports and global events, and it's a lot more fun. So I think that's where a lot of disposable income is moving, as opposed to stock markets that feel like an insider game, crypto that somewhat feels like an insider game, but prediction markets are kind of pure, and that's where we're seeing people move.
Gotcha. And James, do you have any thoughts on prediction markets or any points listed here specifically for you? I guess also the gold versus BTC debate. I'm sure that is raging within within Bloomberg, but that and then along with what happened on October 10th in the crypto markets, which just seemed to like break everything, and we've sort of been trying to recover since that massive liquidation event.
Yeah, pretty much everything I look at, it's like the flows, the assets, any sort of interest, volume even, it all peaked right around that October 10th level for all the digital asset ETFs that I track. And one of my charts that I put out every month is I look at the AUM of US listed spot gold ETFs and US listed spot Bitcoin ETFs. And there was a point where they were within a few billion of each other. Like 15 years later, they all Bitcoin ETFs launched and within a year almost caught up to gold. And now it's not even close. I mean, the gap is $160 billion or something last I checked, though Bitcoin's running right now. But yeah, gold just completely pulled away. Obviously, so that's very fascinating. And the other thing I would say is like going back, I go back to your first point. There really was no blow off top. I think that has to do with new investor base coming in, institutions, advisors. Like they're not coming in and they're not gambling in the way that most people think of like what was happening in crypto from 2017 to 2022, we'll say. They're going in and they're coming in with the set allocation. They're going to go, I'm going to put a 1% allocation to Bitcoin or crypto or maybe five. And they're not like running and gunning, like levering up and doing things like that. When there's a blow off top, they would probably sell and manage down to their allocation goal. And when there's a collapse, my expectation is that some of these guys who have a set allocation goal of 1% or 5%, they're going to be buying when it goes from 126 to 80K. So I think all of that kind of dampens a little bit of the volatility, or maybe not the volatility itself, but the tails, the real large end tails are kind of gone. So I think all of those things you have there is kind of why I'm somebody that thinks like obviously the intrinsic parts of the 4-year cycle coming from the intrinsic parts of the Bitcoin network impact it. I just think that impact is getting having less and less of an impact compared to those other things I was just talking about.
No, agree. Definitely makes sense. And when we think about, again, we've sort of hit on all this already, but miners and retail sort of go hand in hand with the rebalancing of assets and what's running, what's not running. Stephen, I don't know if you have any additional thoughts here on. We'll get to ETFs and DATs in a second, but any other last thoughts here on retail behavior and what it's going to take them to potentially come back? Again, I'm trying to steer this,
Yeah.
towards what it's going to take, right?
Yeah, look, kind of going back to my point you had Microsoft MicroStrategy is the original DAT, and then you had a few copycats in the world of Bitcoin. Probably two are going to be the dominant ones, I believe. The Nakamoto related companies, and then Strive are probably going to be the two second biggest. Um, but the reality is a lot of the large miners that had made a ton of money in the last two cycles decided, well, we're publicly traded. Why aren't we treated as DATs as well? So they took a lot of their excess cash and just started buying Bitcoin. And so now a lot of the large miners, like Mara, for instance, are becoming some of the largest DAT trades too. So you can buy a publicly traded miner, and a big part of their business is just price appreciation of Bitcoin as opposed to earning Bitcoin. And given where AI is going, and given where energy prices are going, and the uncertainty of the mining business, it seems to have played out pretty well in at least the bull portion of the cycle for these trades. So it's one of the reasons why I'm still a 4-year cycle guy, at least through this cycle. And by the way, I agree with everything that James said, that, every cycle is going to be more and more muted. You're not going to, this time we didn't have a blow off top, and we said, well, there's no 4-year, the 4-year cycle's not over because there was no blow off top this time. Like, no, there's not. It's become very, very muted versus other years. But I do expect a total of about 60% from peak to trough in Bitcoin. And we've already experienced a 30% drop. We're coming back a little bit. And again, prices don't move straight up and straight down in any kind of cycle. So I do expect, a bit of a run up here, probably not to an all-time high by any means. But we're getting a bit of a run here at the beginning of the year. You have to also remember that Bitcoin was down in December, and which is where there's some tax loss harvesting. It's a great time to sell Bitcoin and then buy it back in January. And then January, February, March is the time when financial advisors and institutions start making new allocations. So it makes sense that this part of the cycle, or this part of the year, is where you get some mean reversion as well as new allocations. And then given macro, given energy prices, given where Bitcoin miners are, I still expect a trough in the summer before we regain. And one more thing that I'm gonna state, and I know I'm going off script here and off slide, but there's a big belief that a turnover in the Fed is going to cause higher into global monetary supply and lower rates across the board. Um, I think it's going to be very difficult for President Trump to get a new Fed chair confirmed quickly. It is very possible that he could start a confirmation process as early as next month, and people simply will sit it out. The Senate will simply sit it out and wait for Powell's term to expire. And many on both sides of the aisle have stated that. So I think the confirmation process is going to be long, and it could possibly go into the period after the midterm elections. So the expectation of lower rates quickly because of a turnover could disappoint a lot of people until the end of next year, which coincides with the new Bitcoin cycle.
Gotcha. Definitely. And then for
Yeah.
James, you're welcome to jump in on any of that, but I'm very curious on your opinions on the ETF side. How should people think about flows? What should they be watching? This is a monthly chart since inception for BTC. What is a reasonable expectation of in and out here, you think, based on price? Any insights on the ETF side?
I actually have a question for Steve, because he said he could see it like a 60% drawdown. Does it, like, where do you think it go? Like, what does that put us at? I don't even know what the number is. I know like the 200-week moving average is like 58. 8K. Do you think we're going to get down near that levels? I'll say my colleague Mike McGlone is calling for like a 10K price, which I don't agree with, but I'm curious like where you actually think this could bottom out if you think we haven't seen it yet.
Yeah, I think the bottom is probably going to be somewhere in the 60s. Over the summer, if not a little later than that, depending on, again, everything's depending on macro and what happens with the Fed. But if my current prediction is getting into the 60s sometime in the summer or fall.
All right.
That's as far as we go. Unless things get really bad globally.
Yeah, I mean if we have like a 40% pullback in the large cap equity markets, everything's off. To answer your question, Josh, the way I like to look at this, I look at it both the way we have it charted here, and I look at it on a cumulative basis. And like if you look at a cumulative basis, like this is going roughly in one direction. Obviously, there's going to be spurts. If you want to see the growth of an ETF category, the strongest growth you want to see is like, 2, 3 steps forward, 1 step back. That's just the way things go. Like there needs to be some reversion to the mean, some filling of gaps in various different ways. And that's what I'm seeing in these ETFs. And right now we're in one of those pullback periods. It's going to keep pulling back even further. But I would say so far in 2026, these things are pulling in decent amounts of money, particularly like so far in the last week. So the numbers actually look pretty good. And as you can see, the outflow bars are a lot smaller than the inflow bars. So I think a lot of this just has to do with like people are allocating to the space. There are people coming online. A lot of wirehouses haven't even approved a lot of these ETFs. They might have approved Bitcoin and things. We're just now getting index-based products, but I think advisors are going to be more attracted to. So I think there's like so many things that are unwinding going into this year. And another thing, like if we actually do get clarity out of Congress, a market structure bill that like codifies what is and isn't allowed, I think that's also very positive for the space. We'll get people online. That's one of the regulatory things that obviously different from what's going on right now with the Fed, which is a little scary. But yeah, I don't know. I think all of this is positive, and I think no matter what's happening, like if you just look at like the fundamentals of what's happening, particularly in my world of ETFs and advisors and wirehouses and onboarding these funds so that people can invest in them, everything is trending in one direction. That direction is positive from my point of view. But obviously, like I go on crypto Twitter or X or whatever you want to call it, and people are like, you'd think we're in like an 80% drawdown the way some of these people are talking, which I guess is true for some of these real long tail altcoins where people are fully gambling, like Steve was kind of talking about. But for the more blue chip type assets, that's just not really the case right now. And particularly from the underlying fundamentals, from my point of view, things look pretty strong.
Yeah.
Can be good for trading around these things or getting some sort of tactical allocation. So I think those longer tail, I think people are more going to get exposure to them in the coming indexification or basket products that are going to come to market. We have a few now. I think we're going to see a whole lot more come to market and get filed next year. And I think that's where people get exposure to these long tail assets. Because the way I tend to think about it is like, I don't know which one of these, there might be some chain that I've never heard of that becomes the biggest thing in the biggest new thing in crypto 3 or 4 years from now. And it's kind of like the way that I talk to a lot of people that are older than me. They equate it to like looking at like internet stocks in the 90s and 2000s. Like there's something here. I don't know if I certainly don't have the ability to pick the one that's gonna take off, become the Amazon or what have you, or Google. So I think people are probably going to go the index route for the longer tail assets, but obviously there'll be plenty of people just trading the hell out of these things.
Sure.
Absolutely.
So part of it is, as if you can get to at least near break even in the ETF industry and you can keep it open, it might be worthwhile to hold it there for a long time because you never know what's going to happen in the market.
Yeah. By the way, guilty of that. When Josh and I were at Valkyrie, we launched a ETF called Bitcoin on the balance sheet, and
Yes.
nobody cared. And then we shut it down about a year later, all the DAT started rising.
There you go. Hopefully you learn from your lesson, but I don't know what it was costing you guys to operate that thing. So
Too much.
yeah. Yeah, exactly. Yeah.
Speaking of DATs, let's switch gears a little from ETFs and talk about DATs. I know Steven has lots of thoughts here, but I guess the biggest question for everybody is what are the biggest risks here for DATs? Many people think the lower tier DATs are going to explode. They're going to create a spew of BTC into the market beyond what we've already seen, and certainly that's possible, and that could be a factor bringing us from where we are to something like 60K. But then there's this other camp entirely that is just obsessed with MSTR and thinking like that's going to be the first one to go, and sailors cooked, it's over. So, do you have any thoughts on that's going forward, Stephen, and what are the main risks people should be looking out for?
I've always been a big fan of holding some Bitcoin on the balance sheet, regardless of whether you're a DAT or not. We're in a global economy, and typically companies should hold on their balance sheet assets that they can use in the future to pay bills in the currency that they pay those bills in. But in a future digital global economy, Bitcoin makes absolute sense, right? Some of the other DATs are harder to get behind, but I think the ones that work are the ones that are, running, proof of stake, and they're actually holding the token, at the same time validating transactions, earning money that way, and it kind of turns it into more of a pure play. Hey, we're a company that validates the network, and we're holding tokens because we're utilizing those tokens to validate. And I think those are the ones that are ultimately going to work the best that are non-Bitcoin.
Yeah, I mean, I 100% agree with everything Steve said. When I look at it, yeah, I think the Solana and Ethereum DATs, one, validating the network, two, in some cases, putting it to work, lending on the network, earning yield that way, creating cash flow to then go back and potentially buy more assets. That makes sense to me. And also what MSTR is doing is very unique, extremely fascinating to watch. They're basically using Bitcoin to create these financialized products that give you exposure in various different ways. Um, and like I could sit here, the biggest question I get is like, should this be trading a discount or a premium? I know plenty of people who think, I mean, Steve's very familiar with closed-end funds. They often perpetually trade at a discount, and you can make some similar arguments there. I could sit here and steelman an argument for a minor premium because of what Sailor can access and things along those lines. I could also steelman an argument for why I think they should possibly be trading at a minor discount. Um, but like my main thing is things just got overheated. Like trading at 300+% premium for some of these things kind of got a little insane. And it's coming off. And I think the other thing that we didn't even really discuss here, I think DATs kind of took away some of the heat from, altcoins in a way. Like DATs were the altcoin market.
Yeah.
So I think that kind of happened over the last year and change. So yeah, those are my thoughts.
Yeah.
No, absolutely, definitely agree. There were definitely money that was focused at a different place than the altcoin market, and you could see it as when the DATs were launching, right? Switching gears again to the macro side, uh, I guess we'll start with James. Stephen already hit on the Fed changing of the guard at the Fed. Is there anything you're hearing about concerns about any of that? And there's these checkpoint milestone events. The other day it was CPI, today it's tariffs. The Supreme Court keeps pushing off this decision, and I keep hearing from people they're waiting to make allocation decisions, or they're waiting on trades to hear what the Supreme Court's going to do. So any insight or thoughts on what's happening there upcoming within Q1 versus Q2 rollover, for example?
Yeah, I mean, obviously the first one is what you just mentioned with the tariff side of things. The other thing is like looking at what's priced in. I mean, my view is it obviously depends when and how we replace who's running the Fed. But I think right now, based on what I'm seeing, we're priced for two cuts next year. So theoretically, if you do get somebody in there that's beholden to Trump and he really does want things lower, um, that's a risk or a potential tailwind for Bitcoin in this case. But yeah, I won't pretend to be some macro or rate specialist, but I do listen to and I sit next to some of them.
And then for Steven, I guess the rest of the world conversation. Again, we're seeing global indices. If you haven't looked personally, I definitely highly recommend everybody to take a look at indices across the globe that are just they look like silver. They're just straight up. And I think that does take away from the crypto side of things a little bit, because if people have a trade or a way to express an idea that is working really, really well, they're going to stick with that versus maybe allocate somewhere else. So I guess for Steven, any thoughts on the global dovish policies, or how the global macro might affect BTC crypto this year?
Well, Japan tightening, and I'm glad you have that up there, is one of the major factors, has been one of the major factors for short-term moves down for Bitcoin. The US is switching to a more dovish stance, but not necessarily in the way that we want it to. The Fed has decided that they're not going to probably lower rates anymore, at least in this Fed. But instead of lowering rates, they're simply increasing the short end of the balance sheet. Now, who does that help? Lowering rates helps consumers because a lot of consumer lending is priced on low end rates. But uh, adding to the balance sheet and increasing their repo lines helps the banks. And, anybody that says the Fed is and should be independent is not accurate. It is controlled by the largest banks. So it definitely helps them instead of consumers. Um, so so that shift, even though it is dovish, it's not dovish in the right way, and I don't believe it's necessarily helping crypto prices as like it should. But I also believe that, given, recession and pending recession in other countries, real recession where it's a negative GDP, you will see dovish central banks globally that will help lift into monetary supply, which, by the way, is actually a bad thing, but it's a good thing for asset prices.
Sure. And I'll make a soft plug here for some real-time inflation metrics. I don't know how James feels about Trueflation. I'm sure Bloomberg probably has some internal metric for inflation metrics in the US. And I mainly just bring this up because the data integrity of CPI, specifically PPI, all of this stuff has kind of eroded over the past, I don't know, 3 to 6 months. Some people would argue during the Biden administration, it was already gone. But looking at this data in totality, we have the US interest rates, which are higher than the 2-year yield, which some people say should just be the level that the interest rate should be because that's where the market thinks it should be. We have Trueflation in the blue there that is more reactionary because it is real-time data. So it's not exactly CPI, but it's CPI-like. It is generally directionally correct. And over the past month or two, it has continued to decline pretty significantly. I will add here that on the Fed's own nowcast for CPI and PCE and things like that, that has come down month over month for the next 4 months. So from what I'm seeing in both the real-time metrics and the Fed's own estimates, we are likely to see a drop in inflation rates, which may help the doves here as we transition out of the Powell Fed into the new Fed chair. But I guess for either of you, do you have any thoughts here on interest rates relative to inflation or inflation dynamics generally?
I have one thought and then I'll
Yeah.
pass it to Steve because I just want to say my favorite is like this truflation thing. You had like particularly a lot of people in the crypto and Bitcoin crowd who are, inflation truthers, if you will, and they were pointing to truflation and all these things. And now it's lower than the actual CPI and they're not talking about it anymore. So I don't know. CPI is a very inflation itself is a very personal thing. Everyone experiences different ways. If you owned a house during 2020 and 2020 through 2022, you were fine. It didn't impact you. If you were renting or trying to buy a house, you got hosed, right? So like there's all these
Right.
different things, and I feel like that is not talked about enough when we talk about this. Obviously, it's different for like when we're talking about what's going on with the nation at large and the economy and markets. But yeah, I just wanted to point that out. I every the people who were all screaming about it a little while back, no one's really talking about it anymore.
Well, I make a point to talk about it all the time, so I will take up that torch. I will take up
Yeah,
that
yeah, yeah.
torch. Stephen, any last thoughts here on interest rates before we get to our final
And I
poll?
agree. Yeah, I agree 100% with James there. I mean, some of the two of the biggest factors are energy and housing. So energy having to do with, gasoline prices, which has been actually, it's come down under the Trump administration and stayed stable. And with us potentially taking over Venezuela, it'll probably be even better. But housing prices is the biggest factor. And if you live in a home and you've got rent locked in, fine. If you don't, then, well, actually, it's in some cases right now, if you're renting, it's better for you because in a lot of areas rent has come down. But if you're buying a home, given where interest rates are, it's brutal. So it's really probably three different, economies that we're talking about right now.
The other thing I'd say is somebody who's trying to plan a wedding at the moment, inflation's way higher than this.
Sure, sure. Before we finish up here, let's do our last and final poll, Amber. This one's going to be about Beyond BTC. should you choose to do so.
Sure.
Where are you looking, dear listener? Beyond Bitcoin, which crypto sector looks most compelling for 2026? I get a lot of these polls myself, and this is a common question, right? What are you looking at? What are you allocating? Um, it's always sort of the same stuff. But for this poll specifically, enterprise blockchain, alt layer ones, stablecoin platforms, privacy focused assets, which Monero doing quite well over the past couple of weeks here, Ethereum ecosystem, or are you staying BTC Maxi only? And let's close the poll here. We're finishing up. A nice quick one.
Okay. Also, feel free to have people throw in questions if we in the Q&A box share results.
So the top answer by far is alt layer ones, stablecoin platforms, followed by privacy tokens and staying BTC only. And I think there's an important analogy between the Mag 7, the top performing assets that we've seen over the past couple of years, and BTC versus IWM, which is lower caps, zombie caps, however you want to think of them, junk caps, and altcoins. There's a lot of relative value sloshing around where we could see alts do better in 2026 than people think, just because BTC has done so well. Just like the Mag 7 stuff has done so well, NVIDIA has done so well, that we're seeing some rotation out of that and into other names. Real quick here as we finish up again, thanks for joining us, everybody. Thoughts on the drawdown? We talked about this a little bit several times already, but what can impact this? Forced selling is the big one. Forced selling from DATs as well. That's not on here, but Stephen, do you have any expectations on timeline? A lot of people, the first question is always what James mentioned, right? Where's the ultimate bottom? And the second question is, okay, timing wise, why do we think where we think relative to summer and winter?
Yeah. Well, look, James mentioned this briefly, but as a recovering closed-end fund manager, I see the DATs a lot like closed-end funds, and I do expect them to generally trade at a discount long term. Right now, it's a massive discount, but it's because so many came to market. There hasn't been, right now they're figuring out what the supply demand curve is, right? And when that gets sorted out and there's a normalized, supply and demand, they should be trading at like, an MNAV of zero point 0.9 is my best guess. And that MNAV will change based on where interest rates are. Interest rates are going to be the biggest drivers. Like, okay, can I get a better yield out of bonds or owning these DATs, and what's the yield on that DAT, right? Now, if they start distributing dividends, that changes everything. And by the way, that's one of my suggestions to a few DATs that are like, okay, well, what do I do? Everything's going wrong. No, it's not, everything's not wrong. It's just you launch these things into a down market. But if you are earning, say, 7% by staking your token and you're running the validator, then maybe distribute your dividend. And if they're distributing a dividend, then it forces, in a closed-end fund anyway, it forces the discount to narrow, but it'll never go to 1.0 again, unless you're MicroStrategy and doing something fun.
Got it. And then I guess for James, is there any reason like seasonally we would see allocators think about something either quarterly or into the end of the year, or how do you think allocators are looking at this year relative to 2025? Is there enough hair and fuzz off the ETFs that they're like, okay, it's safe to go into the water now?
Yeah, I mean, if you look at, I mean, you guys are doing a survey, there's a bunch of surveys, you can still see there's a lot of people that just aren't in yet.
Yeah.
And at the same time, there's a lot of clients that are asking their advisors or brokers or what have you about this space. I mean, there's people out there who are extremely bullish, calling for outlandish numbers. But like, no matter how you slice it, like the trend is going in one direction. Advisors, brokers, you name it, they are turning these things on for people to allocate. Like I mentioned, I think there's going to be a lot of growth in the index fund part of this market, which will help drive some demand. I mean, if your market cap weighted, that's 80+% to Bitcoin and 15-ish% to Ethereum, and then everything else, depending on how it's weighted. So I think you're going to get other stuff where you can get like X Bitcoin, X X Ethereum, and you'll get some different ways to get exposure that way. So I think people are just going to allocate, they'll be trading around it, but there's going to be people that decide that this is going to be a slug of their portfolio, and that's a long-term tailwind, but obviously that's not going to be enough to, stop a huge pullback. So yeah, I think structurally long-term with the way things are going, it looks pretty positive, but obviously that has not been the case the last few months for this space.
Definitely. And as we look ahead here to 2026, question from a viewer regarding what price action would change your mind about the 4-year cycle. I'll just speak for myself here. If we can get to and hold previous all-time highs, that's a great sign. Mean reverting from 93 to 103, which is what we're in the process of now, is great in the short term, but as Stephen mentioned already, it doesn't necessarily change the outlook for the year unless flows can be sustained, unless we see sellers not come back in at 100, right? I think a lot of the sellers this time go around were sellers that sort of missed the boat on the last opportunity. Like, okay, now's my chance, right? We hit the 6-figure number. So if we don't see those things again, while we regain prices to those levels, I think that's a very encouraging sign. A lot of it's just normalizing that 6-figure price too. It's psychological. Can we get to that level, and can we see people buying instead of selling? That's step one for me. So, Stephen, I don't know if you have any additional thoughts there on what would change your mind on the 4-year cycle, but those were mine.
Well, look, I don't know. It's yet to be seen if how relevant the 4-year cycle will be in the next cycle.
Mm.
I'm still clearly in the camp now, but as minor activity becomes more and more muted, it will eventually go away. I just don't know if it goes away next cycle or not. It's hard to tell until you see it.
Understood. And I guess one final question for James too on stablecoins. Uh, I feel like everybody sort of knows what stablecoins are now. Everybody air quotes, broad generalization for me, but because they've been talked about so much and they've been in the news and regulators have been talking about them and everybody's been talking about stablecoins, do you feel like there's a push there from either educationally or people looking how do I get exposure to stablecoins, right? Like I hear that a lot too. Are you hearing or thinking about that at all on your end?
I mean, just look at Circle's IPO to answer that question. What
Mhm.
happened to the
Yeah.
market cap of that company? I'm not sure. It's not very easy to justify some of the valuations there, but I would say even like just looking internally with my coworkers, like the stable coins on that side of things has made a lot of banks pay closer attention. Obviously, so with the Genius Act, we see the arguments happening in Congress right now with distribution of rewards and interest with the bank lobby versus the crypto lobby. And internally, like we have people who are covering this space now. For a while, it was me really was the only one that was covering this for the most part, and even talking about it. Now our fintech analyst is covering stablecoins. Our rate strategists who sit next to me are covering stablecoins. So it's becoming a lot more serious and taken more seriously, I guess. So that has helped aid. And then I mean, anytime you have, the Treasury Secretary talking about how bullish he is for the case for something like this, it's going to make people pay attention, right? So I think all of those things are good. I mean, the Genius Act is a very good thing, I think, for this entire space. It's a good thing for the dollar long term, in my opinion. And I think my main thing that I'm looking positively toward is hopefully getting some sort of clarity or market structure bill through Congress this year. My colleague down in DC has a 70% chance of passing in 2026, which is out of consensus with most people. A lot of people were a lot more bearish than that, and he's been pretty. He thinks they're going to get it through. The question is how much, what's in there, and is everyone going to like what everyone wants regulation, but is it the regulation they wanted to see? That's what remains to be seen. But it looks to be relatively positive. What the last thing we want is to get no sort of regulation on this entire space and then get a new SEC because a Dem wins in 3 years from now, and all of a sudden we're back to where we were under Gensler, which is not a good thing for the space at all. So regulatory clarity is going to be huge for this entire space. So I think there's a lot of tailwinds, and I know Steve said he's not ready. I think the 4-year cycle is mostly over. It's obviously going to have impacts and different things, but I think it's mostly done.
Yeah, be careful what you wish for on the regulatory side, right?
Yeah.
And I think we're gonna leave it there unless Stephen has any final thoughts. Thanks, James, for joining us. It was a great discussion. Any last parting words for us, Stephen?
Not here.
Well,
Appreciate your time.
thanks everybody. Thanks for your time. And if you want to see the recording, will be up at some point here shortly at places where you find recordings. Thanks everybody. Take care.
Bye. Thank you.